started. So for our audience members, thank you so much for joining us this afternoon. As some of you already may know me, I'm Robin Shabes, the director of the Chicagoland Opportunity Zones Consortium. Welcome to the first conversation in our Opportunity Zones Investor Insight series. Along with myself, Rachel Riley will be moderating the conversation. Rachel is the founder of ACES and Archers consulting firm. So first, let me start by just sharing a little bit of information about the consortium. As some of you may know, we are housed at the Chicago Community Loan Fund. We are mission-oriented, multi-sector collaborative of organizations, all focused around community development in the Chicagoland area. As the consortium, we concentrate on three core activities to facilitate connections around the OZ tool to hopefully stimulate access to that capital. So we do matchmaking where we try to identify opportunities within our footprint, and where it's feasible, make introductions to potentially interested OZ investors. We do a lot around education on the tool. We have many webinars posted on our website, and this is part of our continuing focus on making information accessible around the tool. And then lastly, we focus on technical assistance. Our goals at the highest level are to help create quality jobs, build wealth, and promote equitable development in Chicago and suburban Cook County. This series is a continuation, as I mentioned, of our commitment to provide a variety of educational resources around understanding this flexible tool. The goal of the conversation series is to share high-level insights from OZ fund managers and practitioners regarding the types of impact-oriented projects that investors are funding, the innovative partnership models to achieve community impact goals that investors are engaged in, and the typical investment evaluation process. So with that very brief opening, I'd like to kick off our series with Patrick Mullen, the Director of Strategic Capital Partners at Arctaris Impact Investors. In this role, Patrick is involved in the many phases of the investment evaluation and implementation process. Prior to joining Arctaris, Patrick was the Executive Director of Impact Investing at Sorensen Impact, a University of Utah-based institute that marshals capital for social good. Patrick holds numerous board and advisory positions, including with the Center for Entrepreneurship at Westminster College, where he earned a BS in finance and was recognized with the Distinguished Alumni Award in 2017. Patrick, thank you for joining us. I'd like to turn our conversation over to you to kick us off with an overview of Arctaris.
Well, thank you, Robin, for that wonderful introduction. And thank you, Rachel, as well, for hosting me. It's great to be with everyone today and hopefully spend time both telling you a little bit more about Arctaris, but also learning more about some of the exciting things happening with this group and more broadly in your city. But as a place to start, as Robin suggested, I'll give a little bit of background on Arctaris and how we operate. We're a Boston-based family of impact investment funds. The majority of our capital is opportunity zone in nature. We've launched 3 opportunity zone funds to date, totaling just over $350 million under management. We are now in the market with our 4th OZ fund. And we invest primarily in 3 core asset areas. The first is real estate. So that often takes the form of affordable housing, multifamily housing, really meeting community needs. We've invested in things like commercial development, but that commercial development is very specific, and I'll go into some examples later about creating jobs or having some sort of tangible community benefit to it. We invest in infrastructure that communities need. So broadband fiber has become a very big area where we've invested, particularly in rural, but sometimes urban markets as well. We've also begun investing in renewables like solar and other forms of energy. And the third focus area is in operating companies. So how we invest in businesses that need growth capital that really are creating living wage jobs or really helping grow economies in the places where we invest. And one thing that's very unique to how Arctaris invests our capital is obviously, as an opportunity zone fund, we have to invest in opportunity zones. But rather than sit back and cherry pick the best ones out of the 8,700 plus that were selected, we're very place-based in our nature of how we invest. So we take our equity funds that are raised, and often we'll be partnering with communities where a foundation or a government agency or even a an anchor institution, think like a large healthcare network or corporate who's an anchor in that community, is investing alongside us, but not equity as a capital gains investor in an OZ fund. Usually they're investing what we call kind of catalytic first loss capital, where it's a foundation stepping up and saying, we want Arctaris to come to our city and actually invest in the blighted part of our neighborhoods and go help us build affordable housing there. And to do so, we're willing to put in $5-10 million of our own capital, whether it's as a grant or a low interest loan or some sort of economic development stimulus type package. We'll often match that, sometimes 3 or 4 or 5 times on top of their dollar amount to go do these types of investments. So we're active across the country. We've built programs, like I've mentioned, in places like Baltimore, Maryland, Washington, D.C., Pittsburgh, Pennsylvania. Erie, Pennsylvania is one many may have seen. That's one of our larger programs to date. We have statewide partnerships with the state of Maine. We're in the state of Colorado. I myself am actually based in Salt Lake City, Utah. So the Intermountain West is an area in which we're trying to grow. And we're beginning to really evolve our model, particularly in bigger cities where, rather than creating this portfolio level approach, we'll look at really compelling deals that maybe have that foundation or government support already baked into the deal. So I'll tell you a little bit about some of those investments in places like Los Angeles or Atlanta, Georgia, or even in Alabama, where we've begun doing some really innovative deals. But that's a little bit about how we operate. I know we may go into some more specifics, but wanted to just give that overview. I should mention, I said we're headquartered in Boston. Our team's about 35 people, 70% of whom are there, but we have offices in New York, in Baltimore, in DC, in Los Angeles, Salt Lake, and Chicago. So we were talking about our head of real estate development, Joe Sugiyama, who recently joined our team, is a native Chicago. This is going to show that I'm not a native Chicagoan because I don't know my proper term there, but he would correct me, I'm sure. And we're glad that we have an office in your neck of the woods as well.
Great, thank you. If I could just interject really quickly, we'll hold questions to the end of the conversation to get through some of our moderated questions, and we will come back to the audience for their feedback if we have time for questions.
Excellent, thank you. And thanks so much for being here. Can you talk a little bit about Arctaris's approach to place-based investing and maybe even provide a little bit of an overview of what place-based investing is?
Yeah. I'll say that even before Opportunity Zones, Arctaris was founded in 2009. Our history before the OZ incentive was passed was actually as a growth debt fund. So we would bring debt and lending solutions to companies that were often located in really underserved areas. So think Detroit, Michigan after the Great Financial Recession, or the western parts of Massachusetts, which really have tremendous academics but don't have a lot of economic diversification. And those companies were falling through the banking ecosystem. And we were trying to figure out ways in which we could partner with communities to come in and bring our capital to help lend and grow companies there. And what we found was on the investor front, a lot of people believed in the impact mission. They had a really difficult time on the returns side of that thesis. And what helped bridge the gap was finding relationships where we could bring in those more community-oriented partners who would say, hey, we're a foundation. We have programmatic dollars that we're putting towards trying to solve this issue already. And we don't need the equity-like returns Arctaris' investors are making. We could do this as a program-related investment, which is a very low-cost philanthropic loan or equity investment they could make, or even in some cases, a grant. And it was really the state of Michigan in 2014 that latched onto that model. And for obvious reasons. I mean, I'm sure many of you remember what the sort of part of their state was like following the Great Financial Recession. And the state of Michigan said, we have dollars we want to put towards creating jobs. What if we put up 20% of an Arctaris Michigan fund? That money could be, first in line from a risk perspective, but last in line to be repaid. Would Arctaris be willing to go raise the other 80% and actually go invest in targeted neighborhoods throughout Detroit and Flint and other high need areas? And we sort of started it as an experiment, and lo and behold, it really worked. We raised the Arctaris Michigan Fund. We went out and invested in some really great companies and created some really great jobs. And all of a sudden, we saw the inbound requests on our phone really kind of exploding, where people were saying, well, hey, if you did it in Michigan, why don't you come to Erie, Pennsylvania? Or why don't you come to Baltimore, Maryland? And it just so happened that this was right around the time the Opportunity Zone legislation was passed. And so we went to our investor base and they said, look, a lot of these places where you're already trying to go, they're now being designated as opportunity zones. What if Arctaris could raise an equity fund that could go in and actually help these communities and invest in the things that they want? So our approach to place-based investing, I think, has really followed that model historically, and I'll tell you a little bit about how it's evolving. But what I mean by follow that model is, we'll often work with a place for, it can be as short as 3 months. It can be as long as 2 years. And those are literal examples of how long we've worked with communities before we've invested place-based commitments. But it's to understand both what types of capital are available in the community, whether it's from the philanthropic sector, from the government economic development sector, or from some of these large anchor institutions who want to reinvest. But then also, what are the needs? And are those needs appropriate for an opportunity zone fund like ours to come in and invest? And I'll tell you that in a place like Erie, Pennsylvania, where we started talking to the Erie Community Foundation early on, who said, hey, we're losing people every year in terms of population decline. They're moving to other places where they have better economic opportunity. Part of the reason is our downtown is really kind of rotting. It's not getting the development it needs. We understand no one's willing to take that first leap as an investor, but what if the Community Foundation put up $5 million as a program-related investment loan that could go and go and really help de-risk that? And we matched it with 20 million ourselves from our funds. We created a $25 million Erie program. We were lucky that Erie Insurance, who is the large sort of corporate anchor in that community, then followed on top with another $20 million equity investment in our fund. And today we have a $80 million plus commitment to the greater Erie area to invest in their downtown. And we've really seen it start to thrive over the last few years. What we're finding is there are other communities like that who come to us and say, hey, we're in Baltimore, Maryland. We have the ABLE Foundation and the Neighborhood Impact Investment Fund who want to serve the role of putting up, that first loss capital. Or we have in the state of Colorado, the Colorado Health Foundation, who's very motivated to bring broadband to rural areas, who's willing to give us a $10 million guarantee, which serves as like an insurance policy. But in the city of Los Angeles, where we just did a really innovative deal that I would encourage, I'll send as a follow-up to the group, but it's called Flower Street. And it's a very, capital A affordable housing development that we did in partnership with the city of LA and the United Way. And it's designed to be the first kind of permanent supportive housing for those that are coming out of the transitional housing ecosystem. So these are people that, they're not coming straight from being homeless, but in the last 2 years, there's a good chance they were homeless and they've been working through service providers to get back on their feet. They've been working through the transitional housing system and they're now ready to move into a subsidized apartment. We didn't go to the city of LA and say, well, this is great, but you need to help us identify someone who's going to give us this portfolio level approach where you invest on the front end and then we go put $25 or $50 million to work over the next 5 years. They said, we need you in this deal now. And because the United Way and the city were putting in, grants and low cost capital, it allowed us to look at that model and really do a great deal. So I would say place-based to us can mean two things. It can mean setting up these portfolio level approaches where we're very targeted about long-term investing into specific needs with communities. It can also mean really high need, high impact deals that have that type of capital put into it already and having our firm, come in and take a look at it and see if it's one that we can underwrite and put capital to work. So we're in about a dozen locations. Our annual impact report, I'll give a good plug on our website. If you go to arctaris.com, it's just in the upper banner, says check out our 2023 annual impact report. Does a really good job of highlighting those places, highlighting our portfolio, highlighting how we think about impact in these communities. But we are very intentional. We are not like your typical opportunity zone fund. And I don't mean this in a negative way, but there are just a lot of opportunity zone funds who might sit back and just say, our motivation is financially driven. We're going to go find the easier deals and these bigger cities. We're in places like Lima, Ohio, is an example you'll read about. Its population is less than 40,000 people. So we are willing to go, kind of in line with the true nature of why OZs were passed, which is as a tool of community revitalization and community growth. And that is, very core to the mission of Arctaris.
Thanks so much, Patrick. And I will say that we were plugging that impact report in all of our promo emails. So folks can also link.
Fantastic.
Emails. Yeah.
Well, thank you, Patrick. To some extent, I think you've already shared some examples of the types of investments that you undertake. But if you could spend just a little bit of time talking about the investment opportunities that you do look for, maybe give an example or two that's slightly more detailed, with the thought in mind of the kind of opportunity zones that one might find in a community like Chicago. Our OZs are primarily, at least in the city of Chicago, are primarily in neighborhoods. We don't have any opportunity zones in the central district. So with that kind of development in mind, if you could share some examples.
Yeah, I'll walk through kind of each of those, three pillars, which I think can evolve. But if we start with community-centric real estate kind of being the first pillar, one really good example that I already mentioned is the sort of flagship block development in Erie, which, yes, it is in downtown Erie, but downtown Erie is by no means downtown Chicago. It is very much meant to sort of have that neighborhood-like feel, where the goal in a place like that was really finding housing for bringing back in, young professionals, healthcare workers to support the large healthcare ecosystem that was there, building community spaces so that it could really help unlock the vibrancy of that community. And so we were the largest equity investors in the flagship block development, which is a multi-building, multi-use, kind of phased investment, which includes both affordable and market rate housing. Market rate being critical for Erie because it was a very economically, distressed area. They felt like they have tons of affordable housing. They didn't have the middle housing they needed for those types of working professionals. So having the ability to both serve those needs, but then putting in things like a food hall that featured majority of vendors who were minorities, and included a farmer's market and a place to shop, included services the community wanted, which was everything from a healthcare clinic to a rock climbing gym, which wouldn't have thought rock climbing gym fit in impact investing, but I think that the core was hey, this is part of building a space that really helps the community feel like it's being sort of developed in a way that brings people into downtown Erie. I think another good example would be a recent investment we just did in Braddock, Pennsylvania. So we have a partnership with the R.K. Mullen Foundation for the broader Pittsburgh area and Allegheny and Westmoreland counties. And in Braddock, there really was a need to try and help create jobs. I think they were seeing some economic distress, and they were trying to figure out the industries in which they were both well positioned as a community to take advantage of, but also where they had the right labor force to create those jobs. And cold storage in terms of transportation logistics is a huge need that exists, particularly in that part of the country as well, for how much truck traffic is going through. And so building a state-of-the-art cold storage facility that is going to be operated by a business that is very intentional about bringing in employees from the community, creating living wage jobs, creating pathways to economic vitality. We were really proud of that investment. And when we closed on it and they broke ground, you saw many highly elected officials, both at the state level and the federal level, attending it because they knew what it meant to be in that community. So, those are a couple examples on sort of the real estate side. I would say on the infrastructure side, we have an innovative partnership in the state of Colorado. I mentioned with the Colorado Health Foundation. They're a healthcare-oriented foundation, which you may think is an interesting partner to have on an investment program that is entirely focused on broadband fiber. But they identified that digital divide and connection issue as a huge thing that we're holding back their communities, particularly in rural areas outside of Denver and some of the bigger cities. And so they partnered with us and actually gave us a $10 million first loss guarantee. So it serves as almost like an insurance policy. They didn't put the money in like our other first loss capital partners may do on the front end, but they said, hey, we'll cover you if you experience any losses, and we want you to go invest in the operator of the fiber, building the towers, and making sure these things get connected to the homes that need it. And so our program there is now connected to all of the schools in the area that are Title I, meaning 90% of the students are on free or reduced lunch. They're connected often to some of the lower income housing developments that are there, even mobile home parks. But we're very proud that they're connecting this to help them kind of get online. And there's efforts from the Colorado governor's office to bring in telehealth and bring in remote work opportunities. And then finally, as we invest in infrastructure for communities and real estate, we do actually still invest in companies. And I think a good example is one we did in Detroit, where we actually bought the North American arm of an automotive seat manufacturer called Recaro. And Recaro was, pre-pandemic owned by a multinational company. They had a manufacturing facility outside of Detroit that employed about 300 people. During COVID, they wanted to, shrink the supply chain and move it all back overseas. And obviously the mayor of Detroit and many of the people in that community did not want to see the loss of jobs. In fact, they wanted to see it grow and actually wanted to build another factory to double that footprint. So we worked with them and worked with our investors in Michigan, including the COZC Foundation and others, to actually purchase the North American arm of that business. And we're now helping them build a second factory and really creating some of those jobs. So we try and take, sort of all pillars of what can go into that community, but the core of the model is working with the community to do what they want. It's not us coming in and saying, we think you should build a business in this industry, or we think you should have this type of housing. They're usually telling us what they want. And then we're working with them to say, hey, can this fit our investment model? And how can we work together?
Yeah, such a great investment model and philosophy to approaching community or deploying capital into communities. And I loved all those examples that you shared, Patrick. So if I am a developer or a small business owner and I'm looking for an equity investment, what do I need to have ready to share, to hand over to Arctaris for you all to be able to actually take a look at the investment opportunity? And at what point in my capital raising process should I be approaching you?
Yeah, it's a great question. I will answer it as specifically as I can, with the caveat being that we are in very, very different markets in terms of market evolution and market development. Our smaller check sizes we've ever written as a fund are in the $3 to $4 million range. We've also written $30 million plus checks into projects. So we can have some big swings in terms of what that looks like. But it goes back to my point on really working with communities to invest in what they're looking to do. So to answer your question, if you're a developer or a project owner, normally we like to see some form of business or development plan, including things like early financial models. Usually there is some capital that's been raised, whether it's, I'm a real estate project. I've lined up what I think could be the debt on my project. I've got a few folks in on the equity side, but I've got a gap. And sometimes it's a major gap, right? I have a gap of $10 million of equity that I'm not finding the traditional real estate players are willing to come down and do, because the returns might be a little bit lower than market. It might be too risky of an investment because it is in a higher needs community. And that's usually where we enter and take on a big role in helping that project, continue to evolve and get across the finish line. I will say a couple of years ago, we would say we don't really take any pre-development risk. We really want to be coming in, right as projects are getting ready to break ground. I'm happy to say that is changing, particularly in a lot of these, smaller markets. I mentioned my colleague Joe, who's in Chicago. He does bring a lot of development background to that. We are finding that we're playing a bigger role in that sort of pre-development process on the real estate side. So I would say if you're there, we can look at projects at any phase and really start to engage. And on the company side and on the infrastructure side, we're usually working with companies that do have a track record. We're not a venture investor. We're not doing kind of seed or pre-revenue investments. It's usually companies that have $1 million or more in operating income, but they're having a really difficult time in getting traditional bank finance, or they just don't fit into equity markets because of the nature of their business model. We invested in a company called Specialty Construction Inc. in Cuyahoga. That's a minority-owned business that does construction. And that is something that as they went to the banks, they said, look, your balance sheet is just, you've got a lot of old assets that appreciated. This is really hard for us to underwrite. And asphalt, paving, and construction businesses are just not the ones that align themselves with traditional equity investors. So we can be a really good fit in models like that. And then I would say, again, this whole thing that is core to our model is working with the communities. So often the best investments we'll find are ones where, we'll put community advisory boards together in the places where we're active. They usually include, members of philanthropy or government or other anchor institutions, and they'll be giving us some early input on some of these investments. Like, hey, this is someone who's a developer who has really been trying to get this done and they need help. They need someone to come in and invest, or this is a high need for our community. We want Arctaris to work to try and figure it out. And so we're always willing to roll our sleeves up and spend the time and actually, be bringing as much as we can from our toolkit to try and make these deals happen.
Great. I think that is such wonderful information that you've shared with us so far, Patrick. I know we only have about 5 or 6 minutes left, and we have at least one question from the audience. And so perhaps we can pivot to the question from the audience and see where see what is on the mind of our person.
Yeah, Calvin, you're up if you're still if your question is still ready to go. But you are on mute.
Calvin?
All right, we're gonna go. I see Mohammed also has his hand up, so I'm gonna go over to Mohammed.
Can you hear me?
Yep.
Yes.
Yep.
Oh, thank you. Thank you, Rachel. Patrick, just a quick question. Do you also work with CDFIs?
We do. We work with CDFIs a lot, and I mentioned our sort of historic model being more credit and debt focused. We still have the Arctaris Impact Fund, which is our credit focused fund. So we'll often be lending to businesses as well, in addition to all of the opportunity zone equity work that we have. And we're in the process of hopefully taking that Arctaris Impact Fund and trying to get CDFI designation ourselves. But we usually find CDFIs are great sources of deal referral in both directions. When we see companies that are not the right fit for us or might be too small or have other characteristics, we'll send them to a lot of CDFIs. And then sometimes we'll have CDFIs, send things further upstream to us when they become too big for the footprint that they have. So we work very closely with those groups. And the other piece I'd say is we are also a CDE ourselves, a community development entity. So we do have a new market tax credit allocation. We're going for our second allocation right now at the moment. So we can also bring those new markets, not to our own deals, we have to bifurcate that, but we can bring new markets as a tool to other deals where we could be, very helpful. So long-winded way of saying, yes, we would love to work with CDFIs.
Yeah, that's great, because I heard you say something about the pre-development loan and all that. So I know Calvin and Bob Tucker probably listening in. It's just, my antenna went up because of that. So there might be opportunities. I'm going to go to your website and check it out and all that. And if you don't mind, we'll probably, be in touch. Thanks.
Absolutely. And I know Rachel has shared a lot about our firm, and Robin has as well, but I'm going to put my email in the chat. I'm sure you probably have it, but feel free to reach out to me directly as well for anyone here. I'm happy to take the follow-up and continue the conversation.
Calvin, are you there?
So I keep clicking on unmute. Can you hear me now?
Yes.
Yep.
Okay. Yes. I want to apologize. I had my hand up by accident, Robin and Rachel. But Patrick, I enjoyed your presentation very much. I like the work that Arctaris is doing across the country.
Well, thank you. No, very much appreciated, and look forward to hopefully doing more in Chicago.
I'm going to ask a question unless there's one from the audience. We still have a few minutes left. So Patrick, you talked about some of the other kinds of financings that you're doing, that you're a CDE, you get new market tax credit allocation. I know you are focused on a lot of things. If somebody is interested in wanting to talk to Arctaris and it's not about OZ, are you the right point of contact to get them to, and then you would send them to other folks inside your organization?
I think and I see Maurice has his hand up as well, but I do think that's a good question. I would say I'm probably the best one to start with the disclaimer being that I am certainly not the new markets guru on our team. I'm not the guy leading the lending underwriting, but we work very, very closely as a team, and I think it's a good first conversation that I'd be happy to handle, and then loop in the proper colleague with that. But it's a good question, and I think use me as a jumping off point, and then we'll get you connected to the right part of the organization.
Maurice.
So Maurice.
Hi, Robin. Thanks, Patrick, and the team there. You guys can hear me fine, right?
Yep.
So my question, Patrick, was about timing. So we're a CDFI. I'm the Vice President of Economic Development. I work with Calvin, and Mohammed is on our board, Bob Tucker, as well as Robin. So if we have a project at the CDFI level that needs gap funding, whether it's new market tax credits, OZ equity investments or even loan debt. What's the timing? You may have spoken about this earlier, but what's the timing on closing a deal with you guys in the mix?
It's a fair question, and it's a good one. I mean, obviously, I think it depends on the deal. I will say we have done a few investments where we've underwritten them in a matter of weeks. So, call it 3 to 4 weeks, kind of all in to then get to the final kind of legal closing and, have the deal done in a month and a half, 6 weeks. We've done deals that have taken 6 months. Like when you're dealing with doing, transformational downtown development as the first development to happen in 20 years in a place like Erie, it can take a long time. But if the question is, hey, we have a deal and we need to find an equity investor and they've got to come in the next, 30 days, that's probably a little quick, but it's still possible. I mean, I think we'd be open to starting that conversation and seeing it. I'd say, typically we're moving in the sort of 1 to 2 months, phase, but it just depends on the questions that come up while we're going through the deal. But would be happy to explore it further and see if it was a fit.
Totally
Great.
fair and informative. Yep. Thank you so much.
I think we have time for one last question, even though we're a little bit over. Allison?
Wonderful. Can you hear me all right?
Yep.
Well, Patrick, this was really insightful, and I have a lot of follow-up questions and definitely will be reaching out to dive into specifics, but was curious with the 3 kind of investment areas that you're doing, the real estate, infrastructure, and operating businesses. It sounds like it from some of your projects. Are you often doing those in alignment? Like, let's say within one place-based strategy, you're deploying capital across all 3 areas, or are you tending to look at an area but from one of those pillars versus another?
It can be all of the above. I think we find a lot of synergies where at least 2 of those areas are coming together. It sometimes is hard to have all 3, because if you think about, like, I think Baltimore is a good example where we definitely have, almost a 50-50 split. It's probably even more towards operating companies creating jobs and then trying to invest in housing to also help those people getting jobs. The broadband piece there is an issue, but it's just one that we haven't been as involved in. In Colorado, the next phase we're hearing a lot is, this is great, we're connecting everybody through broadband, but we have a huge affordable housing crisis. Could you help us do that as well? The reason we have those 3, you're spot on. I think we do view it as like holistic community impact. I think in places like Connecticut and Rhode Island, where we have statewide programs, we are seeing all 3 pillars come online. We would love to kind of have it be that way, but it often starts with maybe 1 or 2 and then evolves from there. But it's you're sort of going in the direction of how we think about it, which is, these 3 should be very complementary to each other. And so to the extent they can work, we would love to, find programs that have all of them baked into it.
Wonderful.
Great.
Exciting. Thank you so much.
Well, we are out of time. This was a great conversation. Thank you so much, Patrick. Thank you, Rachel. For audience members, if you still have any questions, you can certainly email me at info@chicagolandopportunity.com, and I can be a conduit. And if you missed part of today's conversation, it's been recorded, so we will be posting this on our website, which is chicagolandopportunity.com. Thank you for joining us for our very first, very interesting conversation, and I hope everybody enjoys the rest of their day. Thanks again.
Thank you, Robin. Thank you, Rachel. And thanks everyone for joining.
Bye, everybody.